Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. Until recently, the market had, more or less, utilized the medium moving average, currently at 84.40, as a sort of a base to push and test higher, and at the same time the topside had been capped, well, sort of, by 3 separate, though not necessarily unrelated, resistances. The first was the April 2012 high at 86.65. This had previously been breached but repaired. The second resistance was the extension to the upper trend line of the June to August 2023 ascending triangle, currently at 87.55. This was, for the most part, not tested in recent times, but it was still there, and it relates to the April 2012 high, as it was created by the overflow in June and July of last year over the same April 2012 resistance. It was only last week that we had the most recent test of this resistance, and to be frank, it was found grievously wanting. The third resistance is unrelated. It is the purple colored neckline on my daily chart of the February to April 2023 head and shoulders continuation pattern, currently at 85.53. This was likewise penetrated in late December, the same as the April 2012 high, but again, only had the single close above it back then, and more recently, due to its declining angle, had helped cap the market in late January, with only a single close over it. And again, 4 weeks ago, once again, only a single close over it. However, 2 weeks ago, this resistance was breached and broken. Where this very recent move higher originates from is the base of the congestion between 83.46 to 84.40, containing the September 2012 high at 84.24, which is a little bit below it, to be honest, really. Well, top side of it. The February 2013 high at 83.50, which is a little bit just above the low of it. The long moving average, currently 83.82, as well as the medium moving average, currently 84.40, which is actually the top of it. However, the journey higher has been a tortuous one, as rises had been limited for a while by the same purple highlighted neckline previously mentioned. Yet the market had in late February built on the congestion below 84.40, plus the green highlighted short medium moving average, currently 84.95. And finally, a golden cross of the medium moving average up over the long moving average just over 2 weeks ago, and staged a move up over this purple neckline. Now, in all this toing and froing, the market may have just turned the recent head and shoulders pattern into a continuation pattern. And as I said last week, and I quote, possibly created another reverse head and shoulders pattern over December 2023 to date. There's a bit of a debate about where the first shoulder should be measured from, plus such a pattern is in the wrong place. But for now, just keep a continuing close eye on the April 2012 high in dark blue and the extension overhead. Is suspect and may become key. Well, end of quote. Well, they were key indeed, as when I last spoke, we were down in the 86.50 zone and looking higher. Now we are in the 89.75 zone, having peaked this week so far at 91.64 and driven right through all the topside potential targets for the previously highlighted reverse head and shoulders pattern. All I can add to this is this: you didn't even allow me the time to lay out any targets topside for the reverse head and shoulders patterns. How impatient can you be? Anyway, what now? Well, I've drawn in bright red a new late October 2023 to early February 2024 bullish Andrews pitch hook to show the bullish angle of attack. The market's currently in between the middle tine below, currently at 88.21, and the upper tine above, currently 92.60. What is interesting here is that there is no fallback onto a bullish shift pitch fork, a shallower one. There isn't one here. What you see is it. Secondly, keep an eye topside on the 38.2% Fibonacci line of October 2020 to March 2022 move at 1997. This one has capped the market this week and is worthy of notice, as is the 50% Fibonacci line of the 2022 move. That's below at 8900, a little above the red middle tine. LME 3-month aluminium. I keep repeating myself here. There was and is a lot going on here, and I sometimes think my trying to explain it may even have made it more complicated. To start with, we have the gapping move higher in December last year that led to the monthly key reversal up, for bullish halfway hesitation in the middle of the rise and a horn top at the end of the rally. Then there was a subsequent drop, which was halted at the October 2022 base support down at 2156. This in turn led to a rise up through two necklines from a pair of reverse head and shoulders continuation patterns. One from February to April 2023 move, and that's currently at 2194, and that's highlighted in bright red on my daily chart. And a shallow one from the June to July 2023 move, currently at 2252, highlighted in bright green on my daily chart. In late January, the rise topped out at a third neckline, coloured in dark green on my daily chart, of the October 2022 to May 2023 head and shoulders pattern. That's currently at head and shoulders top pattern, currently at 2305. And then, judderingly, started to move lower. This was how I clarified what I saw 5 weeks ago, and I quote, "Over this last week," so that's 6 weeks ago, "over this last week, another pattern has started to develop in my mind, and I've drawn it unhighlighted on my daily chart. Is a late October 2023 to date possible potential diamond pattern. It is not a pretty pattern, but I would pay close attention to the converging trend lines for this pattern. I am not in love with this pattern. I will retire if it does not perform, but it does have merit and it's one to watch." End of quote. 3 weeks ago, I highlighted this pattern in dark blue on my daily chart. It's still there. It's still not the best such looking pattern, but as I said earlier, it does still have merit, especially as it looks like we are seemingly breaking higher. Thus, it is appropriate to lay out some potentials for such a pattern topside. Hence, we would have a primary target X in the 2412 area and a secondary hard to reach target X1 in the 2491 area, which is up off the top of my daily chart. A key factor in prompting me to lay out these potentials has been the break higher late 2 weeks ago and early last week out of the small purple highlighted February to early March bear channel, currently 2140 to 2234. A bear channel that I pointed out 3 weeks ago. This bear channel also has own potentials topside of a primary target X2 up at 2336 area. So what's stopping the market getting to these targets? Well, the immediate resistance is being slowly overcome, though there's a lot of backing and filling going on. Thus, we have resistance, much as last week, even though we have been higher in between, at the October 2018 high at 2267. The next real resistance is the previously mentioned dark green neckline, and then perhaps the unhighlighted March to May 2023 head and shoulders top neckline, currently at 2322. Should we reach that high, then target X2 would be liable to be reached and the reassessment would be in order. However, should we drop down back within the purple coloured bear channel again, currently between 2140 and 2234, then a reassessment would need to be made to the top side targets. Now, one final thing, and this may become a big thing in the future, and that is we had a bow tie formation late last week of the rising short moving average, currently 2235, the declining short medium moving average, currently 2229, and the barely rising medium moving average, currently 2232. For any of you who follow bow tie formations, you can easily see that these moving averages are in the wrong order. However, that being said, the theory indicates that the market will move in the general direction of the outgoing moving averages from the bow tie, which, to be honest, looks sideways right now. Additionally, between 15 to 20 sessions after the crossover, we may see a significant move from the bow tie. In this case, generated by the bow tie. In this case, and allowing for some holidays in between, the market may have a move between the 9th and the 16th of April. I will not await with bated breath, as I am not happy about this bow tie formation at all. LME 3-month lead. In mid-November 2023, the market reached its recent zenith at the same high we saw back in August last year, just over 2300, before turning around and leaving behind a V-top, with a substantial extension from early December last year until late January this year. This extension ended up being a bull channel, which is still highlighted on my daily chart in dark blue. The market traveled along this bull channel, staging a false break higher in late January this year before dropping down, all the way down to the congestion around 2000. Not spectacular congestion, but enough to hold prices in a pipe bottom 5 weeks ago. Since then, the market has risen into a very steep ascending wedge pattern, highlighted in bright red on my daily chart, before breaking lower, only to be held at the same support seen back at the start of this year, the January 2020 high at 2039, before starting a fresh rally 3 weeks ago. I was tempted at the time to draw a possible diamond pattern such as we have in LME 3-month aluminium, but as I was back then and still am today, not wholly convinced of this concept, though it is an idea. You see, prices last week continued to break lower, over the 50% Fibonacci line of the March 2020 to March 22 move at 2135, and the 50% Fibonacci line of the May to November 2023 move at 2142, and even the November 23 to February 24 move at 2151. However, as I said last week, and I quote, I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189, end of quote. And so it proved to be, as we peaked in the middle of last week with a high that was importantly lower than the one in late January, and prices have dropped down into a seeming limbo land where there is nothing close apart from the short medium moving average overhead, currently at 2094, with further resistance overhead from the previously mentioned 50% Fibonacci lines, plus the flatlining medium moving average currently at 2110, and barely rising long moving average currently 2124. Now meanwhile below, a long way below, we have some congestion at a lesser Fibonacci line at 2059, but really there is limited support until the January 2020 high at 2039.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.